Hello, good morning, good afternoon, good evening, depending on what time you're actually watching this video. What a glorious morning it is on Moorpark Golf Course. I've decided to take a break to record this brief message for the Cameroonian expatriate community in the UK. And I use that word expatriate very advisedly. There's something that most of us Cameroonians in the UK almost all have in common. Is that desire to buy our first home as soon as we start working. Most of us, as soon as we get our first job, the tendency is to try and secure a starter home, which most of us do. Soon we move on in life, we expand the family, and then in comes the need for a bigger home. Don't actually get to sell that first home, they rent it out and move on to the next home, making themselves a landlord. Some people don't just stop at one, at times they move on to the second or the third home, having a second property to rent. It's this group of Cameroonians that I want to talk to directly. Over the last 3 to 4 years, there's been a very deliberate policy change in the UK to discourage this kind of landlords, which the system calls accidental landlords. Accidental landlords are landlords who don't go out there and say, I want to buy a property and rent. They become landlords just because they moved on to the next home and then to the next one as well, which is great. It's a great way of investing money for the future. However, the British government is trying to actually penalize that through taxation. So there's a massive change in the UK tax system that is going to actually very, very adversely affect people in this category of investment or property ownership. That new law that would almost have a massive game-changing effect on your finances is actually called Clause 24, because it's a Clause 24 of the tax code. You can actually Google, just go onto the internet and Google Clause 24 on property tax, and you'll get the details of what I'm about to give you a snippet of. What that Clause 24 actually says is that going forward, in fact from this year onwards, your interest payment or mortgage payment will not be taken off before your tax calculation is actually done. What does that mean? I'll condense it because I'm trying to make sure this video doesn't go too long. In a short and simple way of describing it is that if, say hypothetically, you have a property that you rent out for £1,000 a month, and you have a tenant that pays you £600 rent every month. No, sorry. Let's say you have I'll take that back. Let's say you have a property that you rent out for £1,000 a month to a tenant, of course. So the tenant pays £1,000 a month, but you have a mortgage that you pay £600 a month for. Traditionally, under the current law, what will happen is you take £600 out of 1,000, you've got £400 left, you take 1 or 2 expenses, you've got maybe £300 left, and you pay the tax on £300. Job done. Not bad business actually. If you can make £300 every month passively, it's great. If you do 2, 3, 4 as passive income, fantastic, great idea. But going forward, the government is actually introducing a new law, which is what is actually being described as Clause 24. And what this Clause 24 says is that when you receive your £1,000 rent and you have to pay £600 in mortgage, that £600 mortgage would not be taken off that 1,000 anymore. You would have to pay tax on the whole 1,000, not on 400 as before. So what this means is that for you with a full-time job, suddenly you have 1,000 times 12, which is 12,000 added to your current income as a salary. So let's hypothetically assume that you are on a 40% tax ban. By suddenly having a £12,000 income, if you pay 40% of that, if we break it down on a monthly basis, if you pay 40% of £1,000, which you collected as rents, you are left with 600, which is just about as much as you need to pay for the mortgage. So you are left with zero. So this, at the mortgage of 600 and rents of 1,000, you walk away empty-handed. Nothing to you for your troubles as a landlord. However, if you start looking at various scenarios, it's not always going to be that straightforward. You're going to have a situation where you, as a property owner, you might actually have to pay a bit of money to have for the pleasure of having a tenant in your property. This calls for concern. So anyone with a full-time job, a high-paying job, with 1 or 2 buy-to-let properties in their name has to actually consult their accountant immediately. Or you can actually call me if you want to have further chats on what exactly you can do or what the effect is. We can talk specific. There are ways that you can actually mitigate this, especially for people who want to invest going forward, who don't already have buy-to-let mortgages. If you're going to buy a property to rent out as an investment, I strongly advise you do it through a limited company. That way, you protect your personal income, and that business or the limited company deals with everything to do with the property and nothing to do with your personal taxes. That way you can separate all your personal tax issues from that of the company. But if you already have 2, 3, 4, or 5 properties in your name, there are a few things that you can do. One, and the most obvious one, is to sell them all right now, pay the tax on it, and then go back to the market if you really want to be a property investor, and then start investing more strategically in a company name. I know most people are very reluctant to sell properties because of tax, but hey, you gotta pay this. We live in a society that's very safe and secure because of taxes that we pay. If you have to pay tax, you have to pay it. You can seek advice from an accountant to try and mitigate your exposure to tax, but tax is one of those things that you have to pay, I'm afraid. So if you have to pay it, so be it. So you can pay and get on with it. The next, apart from the radical step of selling, if you work and your partner doesn't work, you can actually consider moving all the property revenue to your partner. So that way, it mitigates the amount of tax that gets paid if your partner is on a lower income. Say you have a stay-at-home husband, wife, then you can then put all the income from the property into their name. So that way you mitigate the effect of tax. It's a Moorpark mansion. It's a great building. Love it. Yeah. So that is one of the ways that you can actually mitigate the tax and keep the properties on. If you are lucky to have a partner with the luxury of not having a high income, then the other way of actually mitigating this effect of this tax is incorporating. So if you already have a few properties in your name, you can look at moving them from your personal name into a company. For this, I'm afraid you have to seek the advice of a professional. So you must seek the advice of an accountant, because it's a very technical thing to do. There's a high cost involved, so you need to weigh out the cost benefits, because if you put your property into a trust, there's a high cost of maintaining that trust. If your equity in the property is only a few £100,000, you have to weigh out, should I be paying a few £1,000s every year to maintain a trust structure that hasn't got a lot of equity in it? Then you might think, I'm better off selling everything now and starting afresh on a clean slate. You can see my number being displayed on the screen. You can send me a text message with the best possible time I can call you back. We can discuss your specific case. My Dad's Property Group, the company I work for, we can actually help you if you want to, if selling the properties is one of the options that you want to consider. We sell nationwide. We sell through private treaty, i.e. Privately off market, if you don't want people to know you're selling, or we can actually take the property to auction and get it sold for you as quickly as possible. If selling is what you want to consider doing, I strongly advise you do it as soon as possible. Why do I say this? The tax, this clause 24 will get first in over a 4-year period, starting from this year. Many, and when I say many, I mean 80% or higher of landlords do not know of this change. They will get to find out by the end of January this year. That will be the first time that many landlords will wake up and smell the coffee. This is the first time that most people will be made aware of these changes.
Time 1 hour 6 minutes and 42 seconds.
What effect would that have on the market?
Pace 19
you
minutes
have
17
a few
seconds
landlords
per
that will
kilometer.
do a panic sell. So I'm suggesting that if you're going to sell, you're better off getting on the market as soon as possible. You can sell and then wait maybe a year or two into the tax system, when every other landlord that has only just learned of the effect comes on just to panic sell. Then you can buy a lot lower, mitigating the tax that you paid earlier. So the sooner you make a decision, the better. Thank you. Goodbye.